Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money moves that shape our world. And sometimes those moves are so subtle, they're almost invisible until you really look today. We're diving into ExchangeRight Income Fund's latest report. Now these guys are in the real estate game and lately they've been busy tweaking their borrowing arrangements. Think of it like this, they've got a big credit card and they're just increasing their credit limit to grab more funds for their operations. So the main event here is something called a fourth incremental revolving commitment assumption agreement. Now that sounds like a mouthful, right? But what it really means is that ExchangeRight Income Fund Operating Partnership LP, which is basically the company's main engine, has agreed to get some more money. They've brought in a new lender, Synovus Bank, to essentially loan them an extra $35 million. This is all happening under their existing credit agreement, which is like their master loan contract from May of 2024. This new commitment from Synovus Bank bumps up their total borrowing capacity before. They could borrow up to $150 million. Now, with this added $35 million, their total borrowing power under this particular credit line is $185 million. It's like upgrading your credit card to get a higher limit, allowing you to either make bigger investments or just have more flexibility for everyday business operations. This wasn't just a casual chat, this was done according to a specific part of their main loan agreement, section 2.17, which basically outlines how they can ask for and get more money when they need it. The key thing here is that this new loan, this $35 million revolving commitment, it plays by the same rules as the rest of their existing loan. They didn't change the overall credit agreement itself, just added this new chunk of money to it. To make this official, the borrower, that is the operating partnership, had to sign a new note. Think of a promissory note like a formal IOU. This one is for up to $35 million, and it is payable to Synovus Bank. It is like signing on the dotted line for that credit card increase we talked about. This note is just a reflection of the commitment agreement, making sure the loan is properly documented. Now, we also look at what is not happening, and that's often just as interesting. In this filing, it is clear that there aren't any securities registered under Section 12B of the Act. That means their shares aren't listed on any major US stock exchange, like the New York Stock Exchange or NASDAQ. This often indicates a company that might be privately held or has shares traded on over. The counter markets, which can have different implications for transparency and investor access. Here is an interesting checkbox. ExchangeRight Income Fund is identifying itself as an emerging growth company. What this means is they're a company that's relatively new in its public life, and because of that, they get to follow some less stringent reporting rules for a certain period. It's like a probationary period for public companies, giving them a bit more breathing room as they grow. This is often a signal that the company is still in a phase of significant development and might be less established than older, more mature corporations. So, what is the core of this filing? It's all about a significant deal, a material definitive agreement, as the SEC calls it. This agreement, the fourth incremental commitment agreement, is a big deal for ExchangeRight because it means they're getting more financial power. They've secured an additional $35 million. This is just for show. It is about giving them the fuel to potentially expand, invest in more properties, or manage their existing portfolio more effectively. Now, like any public company, ExchangeRight also has to acknowledge the risks. They've put out a whole section outlining factors that could cause actual results to differ. This is standard stuff, but it is always good to look at. They mention risks inherent in real estate, like tenants not paying rent, environmental issues, or even damages from natural disasters. They also talk about the accuracy of their tools for checking tenant creditworthiness and how competition might affect them. It's a reminder that even with more money, the real estate business comes with its own set of challenges. They're also keeping a close eye on inflation and interest rate changes, which can significantly impact borrowing costs and property values. The company is also upfront about forward-looking statements. These are essentially their best guesses about the future. They're saying, look, this is what we hope to do, but remember, things are uncertain. They are telling investors to be cautious. This is a common disclaimer, emphasizing that while they have plans and strategies, actual results can be very different due to all sorts of unpredictable events, many of which are outside of their control. It is a very important part of these filings that investors need to pay attention to. And finally, to wrap up, they've attached all the related documents. These are the actual agreements and notes that make all of this official. Think of them as the legal blueprints for this $35 million transaction. Their exhibit list shows us just how many different agreements and amendments they've had over time, painting a picture of a company that is actively managing its financing structure. Now, digging into the bigger picture here, ExchangeRight Income Fund has just boosted its borrowing capacity. This is a pretty common move for a real estate investment trust, or REIT, that is looking to grow. They're essentially saying they need more capital to achieve their objectives. Being an emerging growth company means they in a phase where they likely acquiring assets and expanding their operations, and access to credit is critical for that expansion. What is interesting is that they increased their borrowing flexibility quite a bit. Going from a maximum of $150 million to $185 million is a substantial jump, a more than 23% increase in their revolving credit facility. This suggests confidence from lenders like Synovus Bank, who are willing to provide this additional capital. However, it is crucial to remember what they said about those risks. More debt means more interest payments, and if the real estate market cools off, or if their tenants struggle, this larger debt burden could become a significant challenge. They are in a business where tenant reliability is paramount, and any wobble in their tenant base could quickly become a problem for their ability to service this debt. A key risk they mentioned is their limited operating history as a REIT, which could impact their ability to pay distributions to shareholders. This, coupled with the fact that their shares aren't T-listed on a major exchange, means investors should do their homework and understand the potentially higher risks associated with less liquid and less established public entities. In conclusion, ExchangeRight Income Fund is taking steps to secure more funding for its strategic goals. The increase in their credit line is a positive sign of financial access, but it also brings with it the amplified risks associated with higher debt levels. Investors should closely monitor how this new capital is deployed and whether the company can navigate the inherent uncertainties of the real estate market. Alright, that is our breakdown of ExchangeRight Income Fund's latest filing. What is your take on these numbers and what they signal for the company? As future, drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.